Good morning. Thank you for joining today's daily webinar where we discuss your live questions on the air. And we also cover certain topics on a daily basis. We've got a great topic in store for you today. Today, we are going to discuss the top mega backdoor Roth solo 401k things to know. This is a very hot item as many self-employed individuals have been opening up solo 401k plans for the last 10 years plus so that they can utilize the mega backdoor Roth solo 401k strategy, which is essentially a way to supercharge your tax-free retirement funds because it allows for high contribution limits on a yearly basis. As always, today's webinar is for educational purposes. We are not going to be recommending or selling investments today, nor will we be providing tax advice on today's webinar. As always, please like this video and share it with others in your network as it helps to get the word out to other solopreneurs like yourself. Okay, let me go ahead and share my screen here. If give me a moment here. Okay, so again, we're going to talk about the top mega backdoor Roth solo 401k things, items to know. So the first item on the list here is that the mega backdoor Roth solo 401k strategy is not impacted by contributions that you make to your full-time employer 401k. For example, let's say that Sally participates in the Walmart or Home Depot 401k. Let's further assume that Sally is also self-employed on the side. She's moonlighting. She has her own self-employed business. Let's further assume that it's taxed as an S corporation. And let's further assume that she makes at least $69,000 of W-2 wages from her self-employed S corporation for tax year 2024. Let's further assume that Sally maximizes her contributions to her daytime employer Home Depot 401k. So she in conjunction with Home Depot contribute the full $69,000 for tax year 2024 to that Home Depot 401k. Well, Sally is still going to be able to make voluntary after-tax solo 401k contributions to her solo 401k plan for tax year 2024. And we'll talk about this a little bit more later, but Sally has time to open a solo 401k plan here in 2025 so that she can make that full $69,000 voluntary after-tax solo 401k contribution based on her self-employed W-2 wages from her self-employed business. So if she reports at least $69,000 of box one, the gross wages, on a W-2 for her side business S Corp, she's going to be able to open a solo 401k plan here in 2025 by her tax extension due date. So her business tax return extension due date, which is September 15 of 2025, since her self-employed business is an S corporation. And she's going to be able to make that $69,000 full amount as a voluntary after-tax contribution for tax year 2024 here in 2025. And the reason for that is because the voluntary after-tax solo 401k contribution falls under the what's referred to as the IRS Code Section 415 overall limit, which means that contributions to another full-time employer plan does not impact your contributions to your solo 401k plan with respect to voluntary after-tax contribution. So she'll be able to contribute 100% of her compensation from that self-employed business up to $69,000, whichever's less. The second top mega backdoor Roth solo 401k item to know is that voluntary after-tax solo 401k contributions are not impacted by your Roth IRA contributions, nor is it impacted by your non-deductible IRA contributions or even your traditional IRA contributions. So we have many clients that will make their full Roth IRA contribution, which is $7,500 for tax year 2024. And they'll make the full voluntary after-tax solo 401k contribution as well. Now, those that make too much income, so they don't qualify for a Roth IRA contribution, they'll make a non-deductible IRA contribution as part of that backdoor Roth IRA strategy, where they'll then convert that non-deductible IRA contribution to the Roth IRA. Well, again, that doesn't impact your mega backdoor Roth solo 401k contributions. Okay, let's talk about the third and fourth mega backdoor items to know. Let me pull up that slide here. So here are the third and fourth top mega backdoor Roth items, things to know. So you can choose to solely make voluntary after-tax solo 401k contributions up to the overall limit of $69,000 for 2024, which increased by $1,000 for 2025 to $70,000. Therefore, you can forego making employee and employer contributions and solely make voluntary after-tax solo 401k contributions. So that's a great thing to know, is that you don't have to make the other types of contributions before you can make voluntary after-tax solo 401k contributions. Therefore, you can choose to solely make voluntary after-tax solo 401k contributions. Of course, you can also choose to make employer contributions and then the rest up to the overall limit as a voluntary after-tax solo 401k contribution. Likewise, you can make solely employee contributions and then the rest up to the overall limit as a voluntary after-tax solo 401k contribution, or you can do a combination where you make both employee and employer contributions and then the remaining amount up to the overall limit as a voluntary after-tax solo 401k contribution. Another top item to know is that you cannot make the catch-up contribution as a voluntary after-tax solo 401k contribution. The catch-up contribution is that amount that you can make in addition to the overall limit of 69,000 or 70,000 for 2025 for those who are age 50 or older. So as this slide here displays, specifically for tax year 2025, you could make the full voluntary after-tax solo 401k contribution of $70,000. But if you're age 50 or older, that catch-up contribution amount, the additional amount of $7,500, that cannot be deposited to the voluntary after-tax solo 401k. Instead, you can make that contribution to the Roth solo 401k directly, or you can make it as a pre-tax solo 401k employee contribution. Now, there's that super catch-up amount effective for tax year 2025 that only applies to those who are a certain age, specifically those who are age 60, 61, 62, or 63 in 2025. those individuals can contribute a catch-up amount of $11,250 instead of $7,500. And that would, and they can apply that as a Roth solo 401k employee contribution or as a pre-tax solo 401k employee contribution. But again, that amount also cannot be applied to the voluntary after-tax solo 401k. Okay, let's talk about the fourth and fifth top mega backdoor Roth solo 401k things to know. So you can convert voluntary after-tax solo 401k contributions to the Roth solo 401k or to the Roth IRA. So we need to update this slide to list Roth IRA as well. It's referencing Roth solo 401k twice. But again, you can choose to make that voluntary after-tax solo 401k contribution and subsequently convert it to the Roth solo 401k, or you can convert it to the Roth IRA instead. One of the slides coming up, we're going to talk about whether you should convert to the Roth solo 401k or the Roth IRA. Another top item to know is that as long as the voluntary after-tax solo 401k contributions are separately tracked in a separate holding account within the solo 401k plan, they are not going to be subject to those pro rata rules which apply to non-deductible IRAs. So that's not going to apply to the solo 401k, which means that when you make that voluntary after-tax solo 401k contribution, it's going to flow directly to the brokerage account or bank account titled in the name of the solo 401k. So this bucket right here. So you would make that $69,000 voluntary after-tax contribution to this bucket here, and then you can convert it to the Roth solo 401k or to the Roth IRA. So as a result, it doesn't subject your solo 401k to that pro rata rule, as long as you separately contribute that voluntary after-tax solo 401k contribution to that specific voluntary after-tax solo 401k bank or brokerage account in the name of the solo 401k plan. Let me pull up that slide here again. Bear with me for a moment here so we can get back to that item there. Let's see here. Oh, here it is. So again, that's that's really great news because there's a lot of confusion in the industry regarding the pro rata rule, and many times individuals try to apply that pro rata rule mistakenly to the mega backdoor Roth solo 401k, but it does not apply to the mega backdoor Roth solo 401k. It only applies to the IRA, non-deductible IRAs, as part of the backdoor Roth IRA, which is a whole different strategy in itself. And here's some great sources to learn more about how that pro rata rule does not apply to the mega backdoor Roth solo 401k. You can look at IRS code 72D number 2, which allows for separate accounting. Again, that's where you have a separate bank or brokerage account under the solo 401k plan dedicated to solely hold those voluntary after-tax solo 401k contributions. And you can also look at IRS notice 2014-54. Okay, let's keep moving on here again. Please like this video as it helps to get the word out to other solopreneurs, self-employed individuals like yourself. We found that in the last few years, especially right now, there's a large demand for self-employed solo 401k plans. So this is a great way to get out the news and educating other solopreneurs like yourself. Okay, let's look at number 6 and number 7 top mega backdoor Roth solo 401k things to know. So While the voluntary after-tax solo 401k contribution is not taxable, it is reportable on a Form 1099-R and on your Form 1040. So the Form 1099-R is used to report not only distributions from solo 401ks and IRAs, but also conversions, whether it's a pre-tax conversion or a voluntary after-tax conversion. You have to report that to Uncle Sam on a Form 1099-R. So when you make that voluntary after-tax solo 401k contribution, that gets reported on the Form 1099-R once you convert that to the Roth Solo 401k or the Roth IRA. But once that contribution gets converted, then it's got to be reported on the Form 1099-R. It's not going to be taxable unless there are some earnings, but typically individuals will convert that voluntary after-tax solo 401k contribution immediately so that there are no earnings. If there are, it's typically a few dollars or less than $100, and only those gains would be taxable when they get converted to that Roth Solo 401k or the Roth IRA. And for clients of my Solo 401k Financial who timely notify us that they converted those funds and they complete our online conversion form, so we collect the necessary information to issue that Form 1099-R, we'll go ahead and issue that for our clients and file a copy with the IRS at no additional fee. That's covered in our annual fee as long as you timely request that. So again, and then you got to report it on your Form 1040. There's a certain section, and we provide exactly where on that Form 1040 to report it when we provide the Form 1099-R to our clients. Another top item to know is that you can still open a solo 401k plan in 2025 and make the full 2024 voluntary after-tax solo 401k contribution. As long as you open that solo 401k plan here in 2025, as long as you open it by your business tax return due date plus timely filed extension here in 2025, you're going to be able to make the full voluntary after-tax solo 401k contribution for 2024. So that's a great way to really supercharge your Roth 401k funds. Okay, those are the top mega backdoor things to know. Now let's go over a few other items here, because obviously before you can even open a solo 401k plan, you have to be eligible to open a solo 401k plan. So let's talk about the eligibility requirements to open a solo 401k plan. So to open a solo 401k plan, you essentially, the obvious is you have to be self-employed. So a solo 401k plan is for owner-only businesses without any full-time, non-owner, full-time W-2 employees who work 1,000 hours or more. So what that means is that obviously if you have your own S corporation, self-employed business, you're going to be a W-2 employee. So this W-2 rule doesn't apply to you because you're an owner in the business as well. But if you employ a non-owner, except for the spouse, there's a spousal exception. If you employ a non-owner W-2 employee in your business, defined as a common law employee in the IRS code, then you need to make sure that that individual is not working 1,000 hours or more in your business, because if he or she does, you will not be able to open a solo 401k plan. So that's an important distinction to make. Now, again, there's the spousal exception. Your spouse doesn't have to be an owner in the business, but she can be a W-2 employee in the business. And if she is a W-2 employee in the business, then he or she can also participate in the solo 401k plan and therefore make contributions as well based on her self-employment earned income. Here's an example of a two-participant solo 401k plan. Let's say, for example, that Sally and Jake are self-employed together in the same business. Let's assume it's an LLC, taxes and S corporation. So the LLC would sponsor the solo 401k plan. Sally and Jake are both working under that LLC. So they would both participate in the plan. So that would be a two-participant plan. So it's still one plan, but two participants and therefore separate holding accounts, aka bank and or brokerage accounts for each participant, that is Sally and Jake. So this slide here, you're going to see 6 total holding accounts referenced under one plan, and that's because each participant, that means Sally and Jake, need to separately track their solo 401k contribution funds. So they can make pre-tax contributions. They would have each have a separate bank or brokerage account, holding account to hold those pre-tax contributions, a separate Roth solo 401k holding account, and a separate voluntary after-tax solo 401k holding account. Keep in mind that for those who are clients of my solo 401k financial or use our services, our plan services, we automatically draft the plan documents not only to allow for the maximum flexibility under the law, but also to allow for all these various contribution types. What is more, you're not required to open up these separate holding accounts right away if you plan to solely make one or some of these contribution types, or if you solely plan to make voluntary after-tax contributions and then convert it to the Roth IRA, then you only need one holding account. But if you decide to make voluntary after-tax solo 401k contributions and then convert those to the Roth solo 401k, then you're going to need a minimum of 4 holding accounts, 2 each for Sally and Jake. That's a Roth and a voluntary after-tax. So again, you don't have to open all these holding accounts right away, and they can be opened later because the plan already allows for it. So again, here's an example. We just went over an example of a 2-participant plan for Sally and Jake. Here's an example of a 1-participant plan where you only have one spouse that works in the business. So it's a 1-participant plan, and therefore it's still just one plan. So under both examples, it's still considered one plan, but under this example, it's just 3 separate holding accounts solely for, let's say it's only Sally that's self-employed. So only Sally would have holding accounts under the plan to hold her contributions. Okay, let's talk about the Mega Backdoor Roth Solo 401k strategy, exactly how it works. So again, we've already gone over the top Mega Backdoor Roth Solo 401k things to know. We talked about the eligibility requirements. Now let's talk about the strategy itself and how it works. Bear with me here while I pull up those applicable slides here. So when you're ready to perform the Mega Backdoor Roth Solo 401k strategy, it's important to know that not all solo 401k plan document providers provide a plan that allows for the Mega Backdoor Roth Solo 401k strategy. Obviously, my Solo 401k Financial is a plan provider that does allow for the Mega Backdoor Roth Solo 401k strategy, but an example of others that do not are the typical traditional Solo 401k providers such as Fidelity, Schwab, E-Trade, Wells Fargo, and a host of others. So those types of traditional solo 401k plans do not allow for the Mega Backdoor Roth Solo 401k strategy. Now, a caveat to that is that many of our clients do utilize Schwab and Fidelity for the solo 401k plan provided by my solo 401k Financial. So they'll use Schwab or Fidelity to hold the solo 401k funds for the plan that we provide that allows for the Mega Backdoor. So not only does Fidelity and Schwab offer their own solo 401k, which is vanilla type, but they will provide brokerage accounts known as company retirement accounts or non-prototype brokerage accounts for a self-directed solo 401k plan from my solo 401k financial that allows for the mega backdoor Roth solo 401k strategy. And the reason why Fidelity and Schwab do not allow for the mega backdoor strategy, which is a question we get quite often through their solo 401k plan, is that it's a very cumbersome type of strategy. You really have to understand the rules. So they don't make any money by offering this type of strategy. They make their money by holding on to your funds, by the deposits. So they'd rather do it that way, where they'll provide the brokerage accounts for a solo 401k plan that allows for the mega backdoor, like my solo 401k financial, who has the expertise to perform the reporting and educate, like we are today, individuals on how the mega backdoor Roth solo 401k strategy works. So you need to first choose and open a solo 401k plan with a provider that allows for the mega backdoor strategy. Then after that, it's time to process that mega backdoor strategy. So again, you're going to need a designated bank or brokerage account under the plan to hold those voluntary after-tax contributions. And we went over a slide earlier how you need to separately track those voluntary after-tax solo 401k contributions in a separate holding account under the plan. And then once you have that separate bank or brokerage account established, which we assist our clients in opening, by the way, then it's time to make that voluntary after-tax solo 401k contribution. And we'll gladly help you calculate that contribution amount. So that's step number 2, where you make that contribution. Then you need to convert those funds from that voluntary after-tax solo 401k holding account over to the Roth IRA or the Roth solo 401k. That's step number 3. Once you've done that, you're going to know exactly how much you converted. And then step number 4, you need to notify your solo 401k provider that you process that conversion. So if you're a client of my solo 401k financial, we have an online conversion form that you would complete where we collect the necessary information to issue that Form 1099-R to the Department of the Treasury. So you would fill out that form, and then the 5th step, that's where the solo 401k provider would then issues that Form 1099-R. So we'll issue that for our clients, and that gets issued in the following year. So anyone who processes a conversion, a mega backdoor Roth solo 401k conversion here in 2025, whether it stems from a 2024 voluntary after-tax solo 401k contribution, it doesn't get reported till the 2025 year, which means that the Form 1099-R would not get issued until next year, January, February of 2026, because the conversion is happening in 2025. A caveat is don't confuse those conversion rules with the contribution rules. The solo 401k contribution rules allow you to make contributions up until your business tax return due date plus timely filed extension. Those are separate rules. The conversion rules are always work with respect to when the funds are actually moved from the voluntary after-tax solo 401k to the Roth solo 401k or to the Roth IRA. So those get reported in the year that they are actually moved over. Okay. So here's another slider that goes over those steps again. We went over the top mega backdoor Roth solo 401k items to know already. Now here's the slide that I wanted to touch on. We get this question quite a bit where clients ask, or even prospective clients ask, if they should convert their voluntary after-tax solo 401k contribution to a Roth IRA or to the Roth solo 401k plan. We put this slide here together to help educate those individuals on this topic here. So it's important to understand that a Roth IRA is not an employer plan. Therefore, you can make distributions from that Roth IRA at any time. Whereas with the solo 401k plan, since it falls under the qualified plan umbrella, aka employer plan, it has separate distribution rules. So typically with the solo 401k plan, in order to make a distribution from a solo 401k plan, that is where you want to take a distribution and because you need to use the funds for other purposes, for personal use, in other words, then you have to meet a triggering event such as either being age 59 and a half or no longer self-employed. Those are the two most common triggering events. Well, that type of distribution triggering events do not apply to Roth IRAs. Now, Roth IRAs are not subject to require minimum distributions. That used to not be the case for Roth solo 401k plans. Well, with the passage of Secure Act 2.0, now the solo 401k Roth is on the same playing field as the Roth IRA, meaning that require minimum distributions no longer apply to Roth solo 401k plans. Now, Roth IRAs you cannot borrow from your Roth IRA. That is, you cannot take a participant loan. Whereas with the Roth Solo 401k, you are allowed to borrow from that Solo 401k plan where you can borrow 50% of your Solo 401k balance not to exceed $50,000, and you can use those funds for any purpose, and then you pay back to the Solo 401k plan with principal and interest consisting of scheduled payments, and you pay back over a 5-year period. So as long as or it can be 15 or 30 years if you have that primary residence exception where you use those borrowed funds towards the purchase of your primary residence. And that's not going to be taxable as long as you timely pay it back pursuant to the payment schedule for that solo 401k. So again, the Roth IRA regulations do not allow for participant loans. Now, many of our clients like to invest in alternative investments, whether it's cryptocurrency, precious metals, promissory notes, private equity, tax liens, but they also like to invest in real estate. And many times they'll utilize financing called debt financing when they invest the solo 401k in a rental property that's going to be owned by the plan. So they'll obtain a non-recourse loan from a bank lender. And we have a host of lenders listed on our website that will perform non-recourse loans to a solo 401k plan for investing in real estate. Well, when a solo 401k utilizes debt financing to invest in real estate, it does not trigger a tax known as unrelated debt finance income tax, which is a tax that does apply to IRAs, including Roth IRAs. So if you utilize debt financing, that's going to trigger that unrelated debt finance income tax if you invest your self-directed Roth IRA or Roth IRA LLC in real estate that utilizes debt financing. Well, again, that unrelated debt financing does not apply to the Roth solo 401k plan. So that's another reason why individuals like to convert their voluntary after-tax solo 401k contribution to the Roth solo 401k instead of the Roth IRA. Um, let's go over a few more items here. Now, another great feature about the solo 401k plan is that it allows for the auto contribution credit. It's a $1,500 tax credit essentially, and it's available to clients who open a solo 401k plan now, where it's a dollar for dollar credit for a total of $1,500. You have to break it or spread it out over 3 years in $500 increments. Now, in order to qualify for this auto tax credit, you have to open a solo 401k plan with a provider who provides a plan that allows for it. Plans offered by companies like Fidelity and Schwab do not allow for it, or even E-Trade and even some of the other banks that offer solo 401k plans. A plan for my solo 401k financial does allow for it, and we draft those plan documents for new clients that open a plan here in 2025 with this feature. And it's a dollar for dollar credit. Now, you don't have to make contributions to the solo 401k plan in order to qualify for this credit, where the government is essentially subsidizing the cost to not only open your solo 401k plan, but maintain your solo 401k plan for years to come. So another item to know is that you are not required to make contributions to the plan to qualify for this $1,500 solo 401k credit. You can opt out of making contributions, or you can still make contributions and you can still qualify. Okay. Now, the credit is claimed by filing on an annual basis Form 8881. There's only a few sections, or not even a section, there's only one section with a few lines that have to be completed. Doesn't take very long to complete, and you file it each year. So, as an example, let's say you open a solo 401k plan here in 2025, or let's say you restate. Let's say you have an existing solo 401k plan with one of our competitors, or even Fidelity or Schwab, and you want to convert over to our plan. That's called a restatement. You're going to qualify for this auto contribution credit starting this year because our plan allows for it. So you'll be able to file Form 8881 next year when you file your taxes to claim that $500 credit for tax year 2025. You'll file a second Form 8881 the following year for 2026, and a final one for the following year, so in 2027, for the final $500 credit. So $1,500 in total, spread out over 3 consecutive years. To learn more about this auto contribution credit, look at these resources here, code section 45T, publication 560 as well. And let me share a great post that one of our colleagues put together here regarding the solo 401k auto contribution credit, because there's a lot of confusion out there in the industry by professionals like CPAs, where they confuse the solo 401k auto contribution credit with the tax credit, which is called the 401k startup tax credit. That 401k startup cost credit does not apply to a solo 401k, but the auto contribution credit does. We put together this great post here on the White Coat Investor that talks about it. So share it with your CPA if he or she comes and tells you that they haven't heard of this or that you don't qualify. So that way they're educated on this. We're constantly educating CPAs and other professionals on this great auto contribution credit, because again, the government is essentially subsidizing the cost to have a solo 401k plan for many years by offering this auto contribution credit. That's the purpose why it was drawn up under the regulations. Okay, let's now keep in mind that if you're an existing solo 401k client of ours, you also qualify for it. Now, this auto contribution credit wasn't available till the end of December of 2023. That's when it really became available under the law. So any client of my solo 401k financial prior to that time period, this auto contribution credit is not available in that plan, but we can update the plan so that it's available now. We can amend the plan, and therefore you would qualify to take advantage of it starting here in 2025 for the next 3 years. If you are interested in having your plan updated, if you're an existing client, to have your plan updated for this auto contribution solo 401k credit, go ahead and submit a support ticket. Let me provide the link to submit that support ticket, and we'll go ahead and provide the information that we need to collect to amend your plan to allow for this auto contribution credit. Let me share that link to our support ticket. And there, I just shot that over. Take a look at that. Now let's take a look at one final slide here, and then we'll check to see if we have any great questions here on today's live chat. So with respect to my solo 401k financial, we actually provide ongoing compliance support, not only educational support like we do on these daily webinars, and we also do through our community website as well as our AI page on our website, which is solo401k.ai. But we also will perform the Form 1099-R reporting, the Form 5500 easy reporting, and that's all covered in our annual fee of $125. We don't charge extra for those services. So the Form 1099-R, as we discussed earlier, is an important return that needs to be filed with the government to report not only distributions from your solo 401k, but also conversions, like the voluntary after-tax mega backdoor Roth solo 401k conversion. So as long as you timely request the Form 1099-R service, we'll gladly prepare that for you, because it's important to note that we don't have access to our clients' funds. So you, as the trustee of the plan, need to communicate to us on a timely fashion or manner if you need that Form 1099-R prepared. And we'll gladly prepare it at no additional cost. Same thing with the Form 5500 easy. That's not a tax return, it's an informational return, which applies to solo 401k plans where the market value of the plan is greater than $250,000 as of the end of the plan year. For example, if your plan year ended December 31st of 2024, then you're going to need to file Form 5500 easy by July 31st of this year. And that's a service, again, that we provide, and we'll file that electronically for you with the government as long as you timely request that Form 5500 easy. Because again, I can't stress this enough. We don't have access to your funds, so you need to communicate to us when you need that service. And again, as long as you timely request it, we'll gladly prepare it for you. And again, this is the type of support that we provide to our self-directed solo 401k clients. Okay, that's the end of my presentation there regarding the top mega backdoor Roth solo 401k things to know. Again, please like this video as it helps to get the word out to other solopreneurs, entrepreneurs like yourself. And let's see if we have any questions here. So I've got a question here. It reads, if I file an extension for 2025, can I still move funds from solo 401k to my Roth 401k? I understand taxes will apply. So great question. So number one, you don't need to file an extension in order to process your conversion this year, whether you're converting voluntary after-tax solo 401k funds or pre-tax solo 401k funds here in 2025. That's going to count as a conversion occurring in 2025, not in 2024, but rather in 2025, because the conversion regulations require that conversions are reported in the year that the funds are actually moved or converted to the Roth solo 401k in the context of a pre-tax solo 401k conversion, or in the context of a voluntary after-tax solo 401k conversion. So that Form 1099-R would be issued for 2025, but it wouldn't be issued till 2026 in January and February. And then you would report that in your 2025 taxes, which are due next year in 2026. So that's an important distinction to understand. All right, great. Well, looks like we've come to the end of our session. As always, thank you for joining today's daily webinar. We'll be back again tomorrow at 10 a.m. Pacific time. Until then, have a good rest of the day.